Mutual Fund joins us as promised. Morning, Harsha. Good to have you with us. Well, we have seen this good 12-13% rally from the budget day lows of 6,800. Now, have we walked enough? Is this a time now you would be wary of buying more? Or are you buying?
No, I don't think the markets have reached a level where you need to be very cautious. I think they've just moved from beaten down valuations to a slightly higher level in terms of valuations. Before the rally, markets were trading at below long-term averages in terms of valuations. Now, after the recent rally, they're just above the long-term averages. So to that extent, I don't think a long-term investor should be worrying about the current market levels. Yes, because of the sharp rally that we have witnessed in the last 1 or 2 weeks, you may witness some amount of consolidation, which is part of the markets. But I think any medium to long-term investor should use this opportunity to gradually build positions in equity in our markets.
Hi Harsha, good morning. You know, at the start of the year, when we asked people what kind of a year this will be, most of them said that this perhaps could be a flattish year. It may not be the 10, 15, 20% type of a return market. Sitting at the current junction, what's your sense? What is the kind of return we can expect from the markets in this 1 year?
We were not actually in that camp. We always believed that earnings growth this year, that is financial year 17, could be in the region of 10 to 12%. And accordingly, we felt that since the markets were reasonably valued at that point of time, it could move in line with earnings growth and hence could give low double-digit kind of upside for the year. And obviously, beyond 1 year, I think things are much better and the earnings growth momentum is going to only build on from here, which means that an investor who's looking for 3 to 5 years will definitely get much better returns than what you would have seen in the previous 3 or 5 years. And that was our opinion at the beginning of the year, and we continue to hold the same opinion even now. And clearly, I think the earnings improvement is around the corner, and once it happens, I think markets will steadily start to move up.
Okay. Well, let me come to some specific statements we got from some of the ministers overnight. The roads minister, Mr. Gadkari, spoke about disentangling all the stalled projects by May 26th. The NHAI chairman also said that he sees 25% more ordering in the current year. I would assume he meant 2016 or FY17. Are you getting a sense that these are the sectors that one should be looking at? Road contractors, cement, allied companies?
Clearly, that has been our investment focus for the past several quarters. We continue to believe that this is a story that can be played for next few years. Roads has been one sector where there has been significant improvement in terms of the new awards and also the execution. The execution of new roads was just about 7 kilometers per day a couple of years back. Today, that number has moved beyond 20 kilometers a day, and the target is going to be about 30 kilometers a day. Similarly, in terms of new awards, we have seen almost 2.5 to 3 times more awards happening in financial year 16, and I believe that the trend in financial year 17 is also going to be quite strong, which means all the companies that are catering to road construction will have definitely better days ahead, and we are playing some of them in our portfolios as well.
Okay. Harsha, I was seeing your top 10 holdings, at least in the Kotak Select Fund, and 3 of them are actually from the cement pack. Ramco Cements, Ultratech, and the other one is Shree Cement. Cement stocks have done well in the last 1 month. Do you expect the upside to continue? Would you consider adding on to more positions to your cement holdings?
No, clearly we are quite overweight compared to the industry as well as with respect to the benchmark. I think we are happy that we are carrying a significant overweight position in cement stocks. And we believe that that's the cleanest way to probably play the infra recovery that's happening in the country. And some of these stocks have just started to perform in terms of stock market performance. Although the business performance had improved in the previous quarter itself, I think now the stock markets are recognizing the upturn in the cement industry. And we believe we are just at the beginning of the upturn from a 3 to 5 year cycle perspective. Even today, the capacity utilization rates in the industry are well below 75%, which means that there is a long way to go before you actually see a saturation in the industry. The demand uptick is here to stay. We have already seen northern and central parts of India coming out with better demand in the last few months. I think that trend is going to only gain momentum as we go forward, and maybe even southern part of India will also contribute in terms of demand recovery going forward. All in all, I think this is one industry which can really do well over the next 3 to 5 years, and we are just at the beginning of the cycle in our opinion, and hence we believe the significant overweight that we are carrying in our portfolios will definitely help producing better results.
Okay, you don't think that the tall boys in the cement sector, the Ultratech variety, have already moved up a goodish bit? Aren't valuations really stretched?
No, we still believe that from a 3 to 5 year cycle perspective, the valuations are still at very low levels, and we are just seeing the demand recovery. I mean, it's again going to gain pace. I mean, if you look at the earlier infra cycle, the GDP was growing at about 9% or so, and the GDP multiplier for the cement industry was in the region of 2 to 2.5x. Now, not only the GDP growth has contracted, even the GDP multiplier for the industry has contracted, and we are just about 0.8, one time GDP multiplier. So I think there are 2-3 triggers that can happen. I mean, the GDP itself is moving up, and the demand for cement can also move up significantly from here. And if you look at the industry over the last 10 years, I think industry has got consolidated in favor of larger players. Larger players today account for nearly half of the overall capacity in the industry, which means that the pricing power is going to be much more substantial in this cycle compared to the previous cycle. And we believe it's also a clean sector. I mean, there is no financial stress in the sector, and if you want to play the infrastructure recovery in the country, this is one of the cleanest ways to play that.
Okay, Harsha, we've got a lot more questions with you. If you could just stay on. We spoke about infrastructure, cement. What about the banking pack? In your key fund, banks as a percentage of your total assets is only about 20%, and that's lower than the average banks hold in the index per se. If you believe in the recovery story of the Indian economy, would you not look to increase your exposure to the banking space? And if yes, would private or PSU be, which would be the better way to play it?
Clearly, if you're looking at financial sector, you have to differentiate between private sector retail-focused banks and public sector as well as corporate-facing private sector banks, because the drivers that are there in these two segments are clearly very, very different. The incremental credit growth is coming from retail sector, which means that the retail-focused private sector banks will do a little better in terms of credit growth going forward. They will gain incremental market share. Similarly, on the asset quality side, the corporate side is not really that great, which means that the banks which are focusing on corporate side will have definitely more concerns on the asset quality. So our portfolio positioning remains focused on these few key drivers, and hence we are more focused on retail private sector banks. That is where we have more overweight position. Although the overall positioning in the banking sector continues to be an underweight position, and that is coming predominantly by being underweight on public sector banks as well as corporate facing private sector banks, and we will keep it that way because there is nothing which suggests that things have changed on the asset quality side. Yes, there has been some cleanup in the public sector banking space, but that's just the beginning in our opinion. So we will see some more quarters of pain in terms of asset quality. And as we go forward, if we find more attractive valuations or if there is a better cleanup that is in the offing, maybe we will look at increasing our holding in public sector space as well. But at this point of time, we continue to believe that it's better to be in retail-focused private sector banks and also some of the well-run, well-managed private sector NBFCs which are focusing on consumer lending.
Okay, Harsha, but some things have improved on the liability side, isn't it, with the cut in both debt market yields as well as the small savings rates. Isn't that opening up any opportunity in, say, the NBFC space, those who depend on wholesale funding, as well if you mix that with some improvement in asset quality, nothing in the public space still attracts you?
No, we do have some position in the public sector banking space. It's not that we have zero position in the space, but we are not looking to increase at this point of time. Yes, we do believe that there is going to be interest rate cut in some time in the country. But this time around, there is going to be marginal cost-based lending rate as well, the introduction of which will happen next month onwards, which means that the lending rates would also go down concurrently. So it's not going to be margin accretive, at least to begin with, and hence we believe whatever fall in interest rates are happening, while it will improve the cash flows for the corporate India per se, but it's not going to really alter overall dynamics of bad asset quality for the industry in general, for the banking industry in general. So we will remain cautious on this space even going forward.
What about real estate or affordable housing, that group? If rates are falling, is there anything in the penumbra that you will find incrementally attractive?
As a space, yes, I think affordable housing is getting a lot of focus from government-related schemes, both from central as well as state governments. But unfortunately, there are not too many plays from a stock market perspective that you can actually hope to build a sizable position. So at that, I mean, because of which I think we still are not looking at real estate stock market investments in a big way.
Okay, Harsha, we'll have to leave it at that. Thank you so much for joining in with your market perspective.